What is the range for valuation multiples based on revenues and profit? Revenues, right? You're going to see anything from 0.5 revenues, that's the low, up to about 1. And so what that means for everybody on the call is we're talking about gross revenues, top line revenues, right? What the clients have paid the firm. Usually on a 3-year average, you're going to look to that number and be somewhere between a 0.5 to a 1. There are definitely outliers on both sides. There are firms that are not run, well, or essentially when we're looking at revenues, if we use it, right, we're not typically weighting revenues approach heavily, but if we use it, we're looking at really how much of the revenues will transition. We're looking at revenue loss, even under a transition plan to kind of see where we go in that framework. But openly, you could have that. We don't see too many firms above that 1 mark. On the earnings side, so you're talking about your net amount, and we're going to adjust that to try to get to what I call true owner's benefit. So that means we have to normalize what salary you should be paying yourself. We have to take some of those perks that you may be doing for travel or Hawaii CLEs when you could take one online. We have to kind of adjust that to get to the true normalized earnings. But when we get there, the most common kind of range that we see is somewhere between a 2.25 to a 2.75 earnings multiple. Now, what that means is if your firm net, after you pay yourself everything else, but net is making $200,000 a year for a small law firm, it could be, again, $200,000 times 2.25 or times 2.75, somewhere in that range. Certain firms are, of course, at 3. Certain firms are above 3. The ones that are above 3 usually have future revenues already in the door, like our personal injury, our plaintiff practices, where they have inventory already there. It's also firms that have more consistency in intake through brand development otherwise, or it's our larger scale firms with less risk of loss, which really, for the most part, can blow above 3 and go to 3.5, go to 4. But those are the outliers to the marketplace. We like earnings approach, just to let you know. Deals get done based on earnings. Banks fund based on earnings, right? Buyers are going to look at earnings because it really says, what is the potential free cash flow? In the market right now, those earnings are maybe lower than expected. We're pushing hard to try to change that. But a lot of that is because the buyers are lawyers. Lawyers are typically risk adverse. They're also self-funded, meaning they're having to use their own funds or borrow funds. We're not a private equity dominated firm. They're inching in, definitely, but it's not a private equity dominated firm. So those lawyers who typically are risk adverse, that's just what we are looking for a greater return on investment, which keeps the multiples a little bit lower. The other aspect is you usually are staying on as a seller in a transition based after closing. That transition after closing has comp tied to it usually. And so that's dinging our cash flow post-closing, which has an impact on overall valuation models and everything else. So there's only so much pie to kind of divide up and split up. And so that's where right now under transactions, those multiples are kind of where they are. So we have a question that says, are firm acquisitions ever done before firm staff?